In this presentation, I'll discuss a strategy with you that you can use to generate an income for life from your savings. As a disclaimer, please review this slide. In summary, I'm offering education and opinion only, not advice. Following this income for life formula, you'll actually never run out of money. I have another slide coming up that will make this simpler to understand. But if you follow some rules, you can make your savings last a lifetime. Some of you may have heard about the 4% rule, and this is a modification to that rule. But this formula mathematically guarantees you an income for life. To get more income from your savings, I suggest that you explore adding the right kind of annuity. An annuity is the only product actually that's available to you that can guarantee an income for life. If you are interested, please contact me first so that I can educate you further. And also I can refer you to an annuity broker that I trust. I suggest you avoid fixed index annuities, variable annuities, index universal life, variable universal life, and whole life insurance products for trying to generate retirement income. They have long payback periods. They have high commissions, which is typically why they're sold. And some can have surrender charges, and others have illustrations that I've seen that are very, very optimistic. I suggest you separate your investment and insurance needs. Insurance really should be used to mitigate risk and not bought as an investment. You should focus your annuity needs on the contractual guarantees that they actually provide. So not on hypotheticals or what they might do, but what they will do. Also, you might get an invitation for a free meal seminar. I suggest you ignore them. They could end up being a very expensive meal indeed. Typically, high commission products are sold at those seminars. You may also want to explore delaying Social Security for the highest breadwinner in the family. There is an excellent tool available by financial engines. You simply enter your specific data into their program, and they'll run many simulations on your scenario to arrive at the most optimum time to start taking income to maximize your payouts. So here's an example of the income for life formula. I'm assuming the percentage of portfolio we are spending is 4%, which is considered to be a conservative withdrawal rate. You can adjust this higher if you're retiring later in life or delaying Social Security. Whatever you're comfortable with and whatever suits your specific needs. This is just an example of how to use this formula. In this example, I will impose a 5% cap on year-over-year spending. This can also be adjusted to your comfort level. The goal of the cap is to save some of the excess gains from our portfolio, if any, for the future. Now assume I start with a portfolio of $1 million in year one. 4% of that portfolio gives me $40,000 to spend in that year, highlighted in yellow. The cap doesn't apply in the first year because we don't have any previous year income. Let's go to year two. In year two, assume the portfolio actually gained and went up to $1,060,000, a good year. I have to do two calculations. One is 4% of the portfolio, 4% of the $1,060,000, which equals $42,400. Then the other calculation is for the cap, which is the $40,000 year one income plus 5%, which gives me $42,000. I can spend the lower of these two numbers in that year, in year two, which is the $42,000 cap, highlighted in yellow. The other $400 stays invested for the future. In year 3, assume my portfolio has gone down this time to 1,038,582. Not so good year. Again, I do two calculations. 4% of year 3 portfolio is 41,543. So that's 4% of 1,038,582 gives me 41,543. My cap is calculated by taking the year 2 income of 42,000 and adding 5% to that, which gives me 44,100. Now I spend the lower of these two calculations, which is the 41,543 highlighted in yellow. Now you follow the same process at the beginning of each year. You calculate the percentage of your remaining portfolio. In this case it would be 4%. Then calculate the cap, and then spend the smaller of the two. Well, here's a very interesting graph for a hypothetical single premium immediate annuity, SPIA for short. You make a lump sum premium payment to an insurance company, and in exchange for that they pay you an income for life. The income you get is a function of the premium you paid, current 10-year treasury yields, which is typically what these products are based upon, and your life expectancy. Those are kind of the three key variables. The bottom scale is the age of purchase when you actually would buy the SPIA. The left-hand scale is the payout percentage. And in payout percentage, the way that's calculated, it's a combination of earned interest, return of premium, or mortality credits. The higher the payout percentage, the better for you, subject to guarantees of the insurance company. An example of the payout percentage. So if your premium was $100 as an example, and the payout percentage was 10%, you would get $10 per year for life. You can see several colored lines on the graph, one line each for 10-year treasury yields, ranging from 0 to 8%, 0% being the worst case scenario. I've shown several rates so that you get a feel for the interest rate sensitivity on these products. The bottom curved line is the SPIA based upon a 0% treasury yield. The colored curved line on top is for a SPIA based upon an 8% treasury yield. So the 1 to 7% lines are in between. So every 0 to 8%. Some facts on SPIAs that you can see from the graph. The older you are when you purchase, the higher the payout percentage. That's because of a shorter life expectancy. The higher current treasury yields are, the higher the payout percentage, just like a bond. So if interest rates on bonds were higher, you get a higher payout, a higher yield from the bond. The payout percentage can also help you determine the payback period on your SPIA. For instance, asking the question, how long would it take to recapture your premium payment? Well, a 10% payout would pay back in 10 years. It's simply 100 divided by 10 equals 10. A 5% payout would pay back in 20 years. That's 100 divided by 5 equals 20. A key advantage with SPIAs is that even if treasury yields are 0%, kind of like the worst case scenario, notice that this SPIA would still pay out over 5% for a 65-year-old. Now that's the power of a SPIA when you are pooling risk with other annuitants. You are getting mortality credits and income for life, which you can't get from any other investment. Here's an example output from the Financial Engine's Social Security simulator I discussed earlier. I entered some specific information for Jack and Jill, including the assumption that both of them will take Social Security at age 70. That's the initial strategy that you see on the left. The proposed strategy on the right actually came from the simulator. It actually suggests that Jill start taking Social Security earlier, at age 66 instead of age 70. In doing so, this would net an extra $49,200 in lifetime payouts. This assumes, of course, achieving average life expectancies. That is the end of our presentation for today. If you would like to explore how annuities would fit into your specific plan, please reach out to me. You can connect with me in various different ways, including social media. Thank you for your time. I wish the best for you. If this presentation has helped you, please pay it forward. Have a great day.